Today is Monday, January the 5th, and this is the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. Today's guests are Mark Soderberg, Mark Bowman, and JP Steiner, all from the ADMIS research team. Starting with the grains this morning, Mark, how important are next week's USDA reports, and what are your expectations?
Yeah, this is one of the biggest USDA reports of the year, as the USDA will be updating their final corn and soybean production estimates from the 2025 crops. In addition to that, we'll get our first glimpse at this year's U.S. winter wheat acres, along with stocks for corn, soybeans, and wheat as of December 1st. I'll be submitting my final production and acreage estimates along with the DS1 stocks within the next 24 to 48 hours with the various media publications, but I'm definitely leaning towards lower corn production. In the past 35 years, final corn production has been below the November forecast 65% of the time, and in fact, the three largest cuts in production from November have all happened within the last 5 years. I don't think you're going to see anywhere near that 275 million bushel cut we saw last year. I'm guessing more like 100 to 150 million. On the demand side of the equation, exports are running very strong, up 30% year to date. The USDA is projecting record exports at 3.2 billion. I don't think that they are going to change it this month after aggressive increases in both November and December. I do fear that the December 1st stocks figure is going to show that feed usage is just not living up to the 6.1 billion bushel figure the USDA has plugged in. That's an 11.6% increase over a year ago, despite the fact that cattle numbers are running 1 to 2% below a year ago. So I think any reduction in production is going to be offset by lower feed usage, keeping ending stocks pretty close to 2 billion bushels. On beans, I don't sense a big change coming on the production side. Historically, it's been about a 50-50 split over the last 35 years. I do look for exports to be cut 50 million bushels. Export commitments continue to lag a year ago. We are down 31%. USDA forecast is only down 13%. So despite the Chinese buying, I think you're going to see a cut there. I look for part of that to be offset by higher crush. I'm going with 20 million bushels higher there. So ending stocks, 20 to 30 million bushels above the current 290 million projection. And on the wheat, I look for acres here to come in almost a million below year ago, 32.25 million acres. That's by forecast. And if realized, that would be a 6-year low.
And Mark, here we go now, looking into 2026, what other macro factors do you see shaping or impacting ag prices?
Of course, weather is always the biggest wild card here, but I think just some of the biggest challenges right now we're seeing in agriculture is simply just the lack of profitability for most row crop farmers, and not just here in the U.S., but globally as well, as commodity prices just not kept up with the surging production costs like fertilizer, labor, machinery, and even interest rates, although they are certainly come down from their peak here a couple of years ago. Global demand for farm commodities is not kept up with the farmer's ability to produce. U.S. farm income is expected to fall 23% in 2026. That's down to $139 billion. And that figure would be significantly worse if it wasn't for the fact of surging cattle prices. Last week, the USDA finally outlined specifics of their $12 billion Farmer Bridge Assistance Program, which will hopefully put some much needed funds in farmers' hands ahead of the spring planting season. But just throwing money at the problem is not going to be a cure, as we'll continue to, the USDA and the Trump administration maintain they're going to continue to address the surging input costs while also working to build sustained markets to sell these commodities in. And that's what's really going to be needed to help stabilize the farm economy.
Thanks, Mark. Mark Bowman, oil's in the news. What effect will the Maduro capture have on global crude oil supply?
So we initially saw a drop in prices, and possibly on ideas that this would be more supply. Certainly, especially by the remarks President Trump made that the U.S. intends to restore Venezuela's oil production. Of course, it will take some time to do that. We still have Maduro loyalists in charge in Venezuela, though the vice president did, after denouncing Maduro's capture, did say that he was less defiant on Sunday, said it was a priority to have respectful relations. Now, ahead of that, Trump had said that he could order another strike if Venezuela does not cooperate. In the meantime, though, the state-run oil company has begun cutting crude production because it is running out of storage capacity due to the U.S. blockade. Venezuela is a member of OPEC. It holds about 17% of global oil reserves, about 303 billion barrels. That's more than even Saudi Arabia does. Their production, though, has fallen off throughout the Chavez and Maduro regimes. Their production in the 70s of 3.5 million barrels a day, and the 2010s fell below 2 million, and last year about 1.1 million barrels per day. So the thing is, if they can accomplish a peaceful transition, the estimates are that it could be 5 to 7 years to build up the infrastructure back to what it was to support that higher production. In the meantime, if relations between the U.S. and Venezuela go along okay, and the U.S. lifts the blockade, it would open up more supply, obviously, and pressure the market. It depends on how these relations develop, and that's something you really can't predict.
And Mark, can you comment on the U.S. cotton market, in particular, how the U.S. exports are faring?
Well, there has been a bit of improvement recently, but no miracles. The USDA, of course, fell behind in their reporting during the government shutdown, and they're just getting back to caught up this week. The latest report had sales at 133,000, almost 134,000 bales for the current marketing year, and another 2,200 for next year. So a total of 136,000. This is down from 183,600 last week, and down from 319,700 the week before that. Now, that was the second time this year that we've been above, or sometime since November, we've been above 300,000, and that was got a good boost in the market off of that because there was a lot of excitement. But repeatedly, we've had the number come in strong one week and then slip a little, but we've also had then another higher number. So it's just has kind of maybe improved the mood a bit towards this. Now, cumulative sales still very dismal. They're the lowest in 11 years. And as a percent of the forecast, only 58% versus a 5-year average of 75% for this point in the year. So this slow pace could have the USDA lower its forecast in the upcoming USDA report, something they may have been reluctant to do when they were behind the reports, but now they're caught up. It doesn't seem like there's any mystery coming around the bend. The trade may still be hopeful that the negotiations, the tariff negotiations, all that stuff will improve U.S. prospects. Vietnam, one of the successful negotiators, is the biggest buyer this year, but they have been the last couple of years. And China, though, coming off a good crop, doesn't look like we could rely on them to step in and be much of a buyer.
Thanks, Mark. JP, what should we expect from this week's non-farm payroll numbers, the December numbers?
Yeah, so there is lots of data on the calendar for the U.S. this week, and based off how the futures market kicked off Sunday evening and markets into today, we are seeing that markets appear to be more focused on the economic calendar than they are with the situation in Venezuela. Friday's payrolls report has the ability to seriously shape expectations as to the timing of a future rate cut from the Fed, especially since this will be the first report that won't really be affected by the government shutdown last year. The Fed's most recent dot plot suggested that policymakers are still expecting one interest rate cut in 2026. Markets are priced in for 2 rate cuts this year, with the first rate cut being fully priced in for June. Fed funds futures right now currently showing around a 16% chance of a Fed rate cut in January. Still, though, December's report is likely to shape expectations as to the timing of when another rate cut could come. Policymakers at the Fed remain split over the condition of the labor market, but overall consensus is that the labor market is cooling. Now, that should come as no surprise. Instead, though, focus remains on how fast the labor market is cooling. Policymakers fully expect to see weakness in the labor market over the coming months, but are more so worried about a labor market that is cooling faster than they expect. Friday's payroll report is expected to show a gain of 57,000 jobs in December, and they also expect the unemployment rate to come back down to 4.5% after ticking up to 4.6% in the last release, although that was rounded higher, reflecting a bigger increase than what actually than there actually was. Now, the payrolls report has been subject to some severe negative revisions recently, which has resulted in 3 out of the last 6 months seeing negative payrolls growth. Gains in payrolls are mainly being attributed to the healthcare sector, which tends to hire regardless of economic conditions, again, reflecting a cooling labor market. So for Friday's report, watch for any signs that the labor market is cooling faster than expected, and pay attention to the sector payroll growth as well. A continuation of recent trends, that being only hiring in the healthcare sector, could add to further expectations of more than one rate cut in 2026. On the other hand, a solid report is likely to delay any easing the economy could see in the near term.
JP, how about a rundown of the rest of the economic calendar for this week?
Yeah, like I said, there's lots on the calendar for the U.S. this week, and a lot of the data does have the ability to shape interest rate expectations in the lead up to Friday's report. Earlier today, we got ISM's manufacturing PMI survey. That came in below expectations and showed that manufacturing activity in the U.S. contracted for a 10th month in a row, while the prices index, although elevated, continue to stabilize at last month's level. The data led the dollar to immediately pair some earlier gains, while Treasury saw a flurry of buying afterwards, bringing yields down. On Tuesday, we'll get S&P Global's services PMI survey, followed by ADP non-farm employment change for December, ISM services PMI for December, and the JOLTS job opening report for November on Wednesday. Since the U.S. is a services-dominated economy, I think greater attention is going to be paid to the services PMIs and are likely to bring a greater reaction in the markets than the manufacturing survey did. The JOLTS report will also serve as a nice indicator for both labor market health ahead of Friday's report. The recent JOLTS report we got, or the latest one, have proven to show a cooling but a sort of a stable hiring versus firing conditions in the U.S. economy. Looking ahead to Thursday, we'll get weekly initial jobless claims data, trade balance figures for October, and the New York Fed Consumer Inflation Expectations Survey. The trade data is for October and is pretty backwards looking, and it'll likely get overlooked ahead of Friday's report, but should still provide an important update on economic momentum in the country, especially ahead of the Q4 GDP data release. That brings us to Friday's labor report, which will be followed by the University of Michigan's Consumer Sentiment and Inflation Expectations surveys afterwards. This week does mark the first full week of trading for 2026, and a busy one at that. Market traders will be looking to parse through the data to better shape their expectations on the timing of Fed policy this year.
Thank you all. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or ADM. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.